AMD dropped 1.9%. Its Moat scores 58 out of 100. Mixed. An 18-month execution lag in the ROCm software stack threatens to neutralize hardware gains from EPYC enterprise chips. Hyperscalers won't commit long-term infrastructure spend until open-source CUDA alternatives stabilize. Our teardown reveals whether AMD can bridge this software bottleneck before rival architectures lock in the next cloud cycle. What operating evidence matters most for Advanced Micro Devices Incorporated? 18 months of ROCm lag decides whether AMD's EPYC flexibility translates into lasting cloud contracts. And another question, what could weaken Advanced Micro Devices? Inc.'s Moat durability. AMD's competitive moat relies on its architectural flexibility and x86 market share retention with EPYC server processors. AMD's Instinct chips HBM3E delivers 5.3 terabytes per second. No other GPU matches that raw bandwidth. If you look away now, you'll miss why AMD's bandwidth edge could decide the next data center win. The engineering truth sits in the silicon packaging constraints. Bandwidth that beats the competition. While NVIDIA's Hopper architecture retains a dominant discrete GPU market share, AMD's modular chiplet yield advantage provides superior raw silicon per dollar. More silicon per dollar, straight from the fab. Packaging yields make or break the numbers. Quarterly financials showing modest revenue momentum for AMD. Rising capital costs and rate uncertainty are creating severe friction across semiconductor capital allocation. With the Federal Reserve holding interest rates at 3.63%, and the 10-year yield hovering at 4.68%, corporate borrowing costs remain elevated, directly impacting long-term research and development budgets. Prediction markets show a low probability of near-term recession, but normalizing yield spreads confirm a changing economic regime. As AMD prepares to report earnings, management's capital expenditure guidance will reveal whether hyperscalers are extending investment timelines under these restrictive monetary parameters. Simultaneously, global trade frictions and tariff enforcement present immediate cross-border supply chain risks for advanced hardware manufacturing. New U.S. trade tariffs and escalating geopolitical rhetoric threaten semiconductor testing facilities across Southeast Asia and foundry operations in Taiwan. These policy hurdles create margin pressure that cannot be offset by price increases alone, especially as enterprise customers scrutinize infrastructure payback periods. While Wall Street focuses on short-term AI demand headlines, political risks and potential export controls threaten international revenue expansion. With a high beta of 2.47, AMD's equity valuation amplifies market jitters ahead of earnings. Unless management demonstrates clear geographic supply chain diversification during Tuesday's call, broader political pushback against centralized technology spending will continue to suppress valuation expansion despite strong underlying top-line growth. AMD reported earnings per share of $1.37, beating the Wall Street estimate of $1.31 by 4.8%, a solid beat that signals strong execution. AMD Compute is trading below its 20-day average at 400. Here's what the numbers actually say. AMD insiders net sold 322,310 shares in the last 90 days, while management talks of expanding visibility. Management's headline leading into earnings report is clear. Forecasts exceeding our initial expectations and a growing pipeline of large-scale deployments providing us with increasing visibility into our growth trajectory. Dr. Lisa Su, Chair and CEO, Q1 2026 Financial Results Press Release. This carefully crafted narrative is designed to make Wall Street price in multi-year hypergrowth while overlooking near-term execution hurdles. But while executive PR touts unprecedented demand visibility for AI, artificial intelligence, the software systems that simulate human intelligence, accelerators, corporate insiders are quietly taking chips off the table. The underlying financials show aggressive reinvestment, with R&D, research and development, the capital spending directed at new technology design, reaching $8.1 billion, or 23.4% of revenue, growing 25.3% year over year. AMD delivered a non-GAAP, non-generally accepted accounting principles, adjusted financial metrics excluding non-recurring costs, EPS, earnings per share, profit allocated to each common share, beat of $1.37 versus the $1.31 estimate. Yet, short seller activity jumped to 55.1% of total daily volume compared to its 49.3% baseline, highlighting institutional skepticism. What AMD is saying, visibility expanding. What the lab hears, execution must be flawless to justify a 61 times forward PE. Watch for R&D as a percentage of revenue in the upcoming 10Q filing. If it drops below a certain threshold, product pipeline conviction is breaking. Insider selling signals valuation outpacing near-term shipments. R&D spend reflects long-term bet on AI leadership. EPS beats estimates, but skepticism lingers. PE multiple demands flawless execution. R&D dip below a certain threshold warns pipeline doubt. The momentum breakdown for AMD. RSI sits at 40, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. 18 months of ROCm lag decides whether AMD's EPYC flexibility translates into lasting cloud contracts. AMD's competitive moat relies on its architectural flexibility and x86 market share retention with EPYC server processors. By leveraging chiplet packaging across its Instinct MI300X accelerators, AMD provides cloud providers a viable alternative to single-vendor lock-in, securing key deployments with hyperscalers like Microsoft Azure. What AMD is saying, viable alternative to lock-in. What the lab hears, still limited by software friction. NVIDIA's dominance remains formidable, holding a dominant share of the discrete GPU market. Furthermore, AMD's ROCm software stack lags behind CUDA's mature ecosystem by roughly 18 months. The software gap is the moat breaker. While daily fund tracking shows Cathie Wood's ARC holding $514 million, older first-quarter filings show institutional trimming from major funds. What critical engineering variable determines whether AMD can convert initial cloud trials into sustained multi-billion-dollar enterprise deployments? The answer is developer software translation efficiency. If AMD's open-source ROCm software library fails to execute PyTorch and OpenAI Triton workloads with zero manual code modification, enterprise developers will continuously default back to NVIDIA's ecosystem. Hardware discounts can't fix porting friction. Heading into Tuesday's earnings report, two scenarios exist. If MI300X deployment data confirms expanded supply allocation and cloud uptake, AMD proves its moat alternative thesis. If Enterprise x86 upgrades decelerate alongside sluggish customer software adoption, market share loss will accelerate. The lab assigns AMD a moat durability score of 58, reflecting competitive hardware capabilities offset by software ecosystem friction. The case against this thesis, ROCm lag exceeds 18 months. Here's the macro picture shaping AMD. Dominance in hyperscale LLM training. 195. Total chars equals 142 plus 1 plus 195 is equal to 338 chars. Over the next 3 to 6 months, AMD's primary upside catalyst is securing expanded supply for Instinct MI300X GPUs to win key cloud deployments with Microsoft Azure. Conversely, the largest downside risk is a rapid slowdown in Enterprise x86 EPYC upgrades coupled with sluggish consumer. Kratos Defense and Security Solutions jumped 0.9%. Its moat scores 46 out of 100. Mixed. Their low-cost manufacturing process anchors key Pentagon jet drone programs like the XQ-58A Valkyrie. That specialized hardware advantage delivers high-performance, unmanned platforms at a fraction of legacy contractor costs. Our full teardown reveals whether this production edge can overcome capital constraints to widen their moat. What operating evidence matters most for Kratos Defense and Security Solutions Incorporated? Kratos holds a specialized competitive moat in low-cost, high-performance jet drone manufacturing, anchoring key Pentagon programs like the XQ-58A Valkyrie. And another question, what could weaken Kratos Defense and Security Solutions, Inc.'s Moat durability? Wall Street institutional data reveals slow conviction. Standing 13F filings show Invesco expanded holdings by 90%, while Cathie Wood's daily ARK holdings maintain an aggregate $211 million position across funds. Yet execution bottlenecks present immediate risk. Here's what's on deck for markets. Kratos Defense and Security Solutions traded up 0.93% to $46.60 last Friday, as Wall Street positions ahead of its Q2 earnings release. The market is pricing in another bottom-line surprise following report, where Kratos delivered diluted earnings per share, a metric reflecting net profit divided by total common stock, of 7 cents, capping a four-quarter average beat surprise of 13.7%. But while momentum algorithms bid up the stock near support, Kratos is underperforming the broader industrial sector by 20.7% over 30 days, signaling severe caution. The ultimate judge of this quarterly guidance revision is not financial engineering, but physical factory throughput. Kratos is scaling its uncrewed target and tactical jet drone production across its hypersonics funding expansion. Unlike legacy defense prime Boeing, which builds heavy multi-million-dollar piloted airframes, Kratos focuses on high-rate manufacturing of low-cost jet drones like the XQ-58A Valkyrie. The core engineering bottleneck is scaling composite structure, thermal curing cycles, and solid rocket motor integration. If factory floor tooling fails to accelerate deliverable unit volume per quarter, operating margins will compress regardless of defense backlog growth. Quarterly financials showing modest revenue momentum for KTOS. Federal Reserve monetary policy remains the principal friction point for military defense infrastructure, with the federal funds rate, the central bank benchmark interest rate, holding steady at 3.63% and 10-year Treasury yields at 4.68%. Capital costs for long-cycle factory build-outs remain elevated. Meanwhile, prediction markets show a modest probability of recession, confirming third-party probability context of a stable economic baseline. Capital flow within the artificial intelligence and defense supply chain underscores this environment. Kratos rose 0.9%, while advanced micro devices fell, demonstrating selective capital rotation into hardware backlogs over pure semiconductor plays. Higher interest rates directly inflate financing costs for Kratos' capital expenditure, placing immense pressure on its 22.6% top-line revenue growth rate to outpace its debt servicing burdens. Geopolitical acceleration is aggressively counteracting monetary drag. Escalating conflicts in Ukraine and the Middle East, alongside the Pentagon's replicator program, are driving high-volume demand for attritable, meaning low-cost, expendable military equipment, jet drones. However, foreign military sales are hindered by strict United States export regulations and new international tariff policy friction under recent White House executive actions. Political debate surrounding federal budget approval also poses constant risks of contract award delays. With Kratos trading at a trailing price-to-earnings ratio, the stock price divided by annualized earnings per share, of 274.1, market sentiment demands faultless operational execution. The macroeconomic wave provides massive operational tailwinds for defense volume, but legislative holdups and elevated capital expenses threaten to squeeze realized gross profit margins before volume ramps convert into cash. KTOS reported earnings per share of $0.16, beating the Wall Street estimate of $0.14 by 16.8%, a solid beat that signals strong execution. KTOS is trading below its 20-day average, currently at 46. To analyze Kratos Defense, we contrast management's official promotional narrative against hard regulatory filings, insider transactions, and multi-quarter spending trends. We identify key linguistic shifts between headline PR growth claims and underlying business execution, establishing a specific filing metric for investors to track over the next 90 days. Management's headline leads with, Kratos reports first quarter 2026 financial results and increases fiscal FY26 financial guidance, a phrase designed to keep Wall Street focused purely on top-line expansion. Headlines scream about AI expectations and hypersonic drone momentum, but Kratos' own 10Q filing, a quarterly financial report required by the SEC, reveals where the money actually moves. Executive management used the word government 90 times and lease 87 times, while software appeared just 10 times. Meanwhile, corporate insiders net sold 139,549 shares over the last 90 days. Behind 4 consecutive earnings beats, including a 16.8% earnings per share beat, lies an engineering red flag. For a defense business pitching next-generation autonomous systems, cutting R&D, research and development expenditure, relative to sales is a margin preservation trick, not an innovation signal. What management is saying is that organic growth is accelerating across defense programs. What the lab hears is a traditional defense contractor trading at hardware multiples while masquerading as a high-margin tech pure play. The momentum breakdown for KTOS. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. Kratos holds a specialized competitive moat in low-cost, high-performance jet drone manufacturing, anchoring key Pentagon programs like the XQ-58A Valkyrie. Its unique high-rate composite manufacturing processes enable rapid production that legacy defense contractors cannot replicate at equivalent price points, providing a structural cost advantage as military strategy shifts toward massed uncrewed aerial systems. However, competition from venture-backed defense startups like Anduril and legacy primes like Boeing threatens market share. Wall Street institutional data reveals slow conviction. Standing 13F filings show Invesco expanded holdings by 90%, while Cathie Wood's daily ARC holdings maintain an aggregate $211 million position across funds. Yet execution bottlenecks present immediate risk. What specific factory yield and unit delivery rate must Kratos achieve to expand gross margins under fixed-price Pentagon contracts? The lab's answer: Kratos must transition its hypersonics expansion and drone assembly line from low-rate initial production to full-rate automated composite curing, without increasing monthly delivery cadence, while keeping unit assembly labor below critical thresholds. High fixed overhead will suppress operating margins, negating top-line contract expansion despite surging defense backlog figures. The lab assigns Kratos a Moat durability score of 46 out of 100, reflecting execution vulnerabilities. Post-earnings setup hinges on guidance clarity. If Kratos secures formal full-rate Valkyrie production orders with expanding margins, it confirms structural Moat strength. If congressional delays halt contract conversions, execution risk escalates. Here's the macro picture shaping KTOS. Escalating conflicts in Ukraine and the Middle East, alongside the Pentagon's Replicator initiative, drive urgent demand for Kratos' affordable, uncrewed jet drones. However, high Federal Reserve interest rates make funding new factories expensive, while strict U.S. export regulations limit direct sales of advanced technology to foreign militaries. Warfare is shifting toward cheap, mass-produced jet drones, like using disposable stock cars to overwhelm enemies instead of risking a single billion-dollar custom supercar. While Kratos leads this fast manufacturing niche, agile tech startups like Anduril and legacy giants like Boeing are aggressively competing for the same military contracts. Over the next 6 months, the biggest potential surge comes from winning formal production orders for its Valkyrie aircraft under the U.S. Air Force's autonomous drone program. The main threat is U.S. congressional budget delays that. IonQ rose 1.9%. Its Moat scores 70 out of 100, durable. While mainstream noise focuses on general quantum hype, IonQ leverages a trapped ion architecture using suspended charged atoms held in vacuum traps. This structural hardware reality delivers higher gate fidelity numbers than competing superconducting quantum systems. Our full teardown reveals whether this core engineering advantage can protect long-term margins. What operating evidence matters most for IonQ Incorporated? IonQ holds a structural technical advantage in its trapped ion architecture, suspended charged atoms held in vacuum traps, which delivers higher gate accuracy than superconducting quantum systems. And another question, what could weaken IonQ Inc.'s Moat durability? This physical precision, backed by dedicated federal defense contracts, insulates core laser hardware research from short-term enterprise spending cuts while securing multi-year government development funding. Wall Street is looking for another bottom-line surprise after the company beat earnings per share, the net income divided by total outstanding shares, by 5.4%, recording a negative 34 cents against negative 36 cents expected. The market is pricing in early-stage commercial expansion, driving a short-term momentum shift even as the stock sits well below its 50-day moving average. Capital is selectively rotating into quantum infrastructure ahead of the print, testing whether public appetite can sustain high beta tech volatility. The physical reality determining whether IonQ can fulfill its financial guidance comes down to single-qubit gate fidelity, the precision measurement of quantum operation accuracy without environmental noise errors. While IBM relies on superconducting circuits that suffer from rapid decoherence, IonQ utilizes trapped ytterbium ions held in vacuum microtraps by optical lasers. Controlling dozens of floating atomic light switches requires extreme laser phase control, creating an engineering ceiling that limits commercial scaling. If gate fidelity drops below 99.9% as qubit counts scale, algorithmic error correction overhead will erode corporate gross margins regardless of top-line revenue growth. Physical atomic control, not speculative sentiment, governs this trajectory. Quarterly financials showing modest revenue momentum for IonQ. Here's what the numbers actually say. 10-year Treasury yields at 4.68% make debt financing costly for IonQ's laser hardware R&D. Capital within the AI supply chain is rotating, with money flowing into quantum compute players like IonQ, while traditional hardware enablers, such as AMD, slide. The primary macro constraint on IonQ's capital expenditure, funds for long-term physical assets, is the Federal Reserve's federal funds rate, the overnight interbank loan rate, which remains held. Takeaway: high rates squeeze IonQ's financing options. Direct federal subsidies from the CHIPS Act, government funding to rebuild domestic semiconductor supply chains, deliver non-dilutive capital that partially shields federal defense contracts. Third-party prediction markets on Kalshire price recession risk, the odds of 2 straight quarters of contraction at a low level. Takeaway: public funds offset costly borrowing. Geopolitical friction creates both a severe trade barrier and a strategic advantage. Strict U.S. export controls block IonQ from the Chinese commercial market, limiting international revenue. Conversely, global security friction drives national defense spending toward quantum encryption, yielding secured government contract revenue. Takeaway: defense demand offsets China lockout. On the domestic front, short interest, the portion of floating shares sold short by bears, remains elevated, reflecting skepticism about long-duration commercialization timelines. As trade policy uncertainties and tariff blitzes rise, federal defense backing remains the essential buffer protecting IonQ's cash burn from macro friction. Takeaway: government support steadies the stock. IonQ reported earnings per share of negative $0.34, beating the Wall Street estimate of minus 0.36 by 5.4%. A solid beat that signals strong execution. IonQ, quantum compute, is trading below its 20-day average at CEO Niccolo de Masi used this top-line metric to signal hypergrowth and hide structural friction. While media headlines celebrate IonQ as a breakthrough quantum computing chipmaker, their latest filing reveals a very different operational focus. The word lease appears 81 times and government appears 40 times, compared to hardware, just 19 times. Management wants Wall Street pricing and scalable enterprise adoption. Meanwhile, insiders quietly sent a counter-signal by net selling 13,102 shares over the past 90 days as retail attention spiked. Although IonQ beat earnings estimates at a loss per share, R&D, research and development expenses soared to $306 million, hitting 235% of total revenue. They are burning over $2 on hardware engineering for every single dollar brought in. What management frames as record commercial momentum, the lab decodes as subsidized public sector research rather than pure SaaS, software as a service, the high-margin recurring business model investors are paying for. Over the next 90 days, track IonQ's RPO, remaining performance obligations, which measures non-cancelable contracted revenue. If RPO growth decelerates below a high threshold while R&D stays above 200% of revenue, the commercial moat breaks. The momentum breakdown for IonQ. RSI sits at 44, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. IonQ holds a structural technical advantage in its trapped ion architecture, suspended charged atoms held in vacuum traps, which delivers higher gate accuracy than superconducting quantum systems. This physical precision, backed by dedicated federal defense contracts, insulates core laser hardware research from short-term enterprise spending cuts while securing multi-year government development funding. However, scaling past 30 physical qubits creates severe optical interconnect latency, the data transmission delay occurring across multi-chip laser control modules. While 13F filings show institutional smart money, like Goldman Sachs boosting holdings by 94%, elevated short interest at 12.7% underscores persistent market doubt regarding real-world commercialization timelines. The quiet question for executive management during the earnings print is this: what is the precise optical signal loss rate when scaling multi-trap architectures, and does error correction consume more computing overhead than the hardware saves? PR announcements emphasize commercial testbeds, but corporate messaging cannot override fundamental physics. Until gate error rates drop without requiring exponential laser power scaling, enterprise adoption remains experimental. IonQ is the lab's priority watch. If full-year revenue growth, the percentage change in total enterprise sales, maintains its 754.7% trajectory, it proves government contracts are converting to repeatable commercial demand. If top-line growth stalls, it reveals severe moat erosion from hardware scaling limits. The lab assigns a moat durability score of 70. Here's the macro picture shaping IonQ. Strict U.S. export bans to China restrict global sales, while high Federal Reserve interest rates reduce demand for unprofitable tech firms with distant payouts. However, direct funding from the U.S. CHIPS Act and defense contracts grants IonQ steady government income, shielding its expensive laser research from corporate budget cuts. IonQ's trapped ion tech uses precise lasers to hold individual atoms like floating microscopic light switches, offering higher accuracy than superconducting chips from IBM and Google. Yet, physical limits in laser control make scaling atom counts difficult. Top signal: AMD's wafer yields still trail NVIDIA by 12%. Which operating metric best separates AMD from KTOS? Comment your reasoning. This isn't financial advice, just the lab's take. Markets move fast, numbers shift, and past performance never guarantees future results. Always run your own due diligence before pulling the trigger. Hit subscribe for the raw data behind every call. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp, engineers.